SMCI stock just gave investors a pretty crazy update. The company reported huge AI demand, more than $60 billion in new orders, and a massive revenue forecast for fiscal 2027. And yet, I think investors need to slow down for a minute. Because when a stock moves this fast, the biggest question isn't always how high can it go. Sometimes the better question is, what could go wrong? Today, I'm breaking down the 5 biggest risks I see with Supermicrocomputer, or SMCI. And stay until the end, because risk number 5 could be the one that decides whether SMCI eventually moves toward $50 or struggles to hold 30. So let's get into it. First, let's talk about the biggest risk. Risk number 1, margins. This is something I think a lot of investors are overlooking. SMCI's latest quarter looked extremely strong. Revenue came in at around $11.1 billion, while adjusted earnings came in at $1.70 per share. Even better, gross margin jumped to roughly 17.5%. That sounds fantastic. But here's the twist. Management's fiscal first quarter gross margin outlook is much lower, around 10.4 to 10.8%. That's a huge difference, and this matters because Supermicro operates in a business where revenue can grow extremely fast, but profits don't necessarily grow at the same speed. The company is selling expensive AI servers, but competition is intense. So if SMCI has to cut prices to win large customers, revenue could keep climbing while profitability gets squeezed. And honestly, this is one of the first numbers I'd personally watch every quarter. Because I'd rather see SMCI grow slightly slower with healthy margins than grow extremely fast with margins collapsing. Now here's where things get interesting. Risk number 2 is connected directly to that massive $60 billion order number. Risk number 2. Can SMCI actually deliver? Supermicro says it received more than $60 billion in new orders during the fourth quarter. That's an enormous number, and it explains why investors became so excited. But an order isn't the same thing as revenue sitting in the bank. Those systems have to be manufactured. They need GPUs, networking equipment, power systems, cooling infrastructure, and a lot of other components. And management already said some customer deployments were delayed because of power, cooling, and networking issues. So the question I'm asking is simple. How quickly can all these orders actually turn into revenue and cash flow? If execution goes perfectly, this could be a massive growth story. But if customers delay deployments, the stock could become extremely volatile. And that's something I would keep an eye on. Risk number 3, competition. SMCI is not operating alone. You've got companies like Dell and Hewlett-Packard, enterprise competing for AI infrastructure spending. And obviously NVIDIA sits at the center of the AI ecosystem. The AI infrastructure market is growing incredibly fast. But here's the problem. When an industry becomes extremely profitable, competitors usually show up. And if larger companies decide to compete aggressively on pricing, Supermicro could be forced to sacrifice some margin to maintain market share. That's why I don't think investors should only watch SMCI's revenue. Watch its gross margin, watch its customer growth, and watch whether the company is gaining market share without destroying profitability. Because revenue growth alone doesn't tell the whole story. Now here's risk number 4. And this one is a little different. Risk number 4, customer and AI spending concentration. The AI boom is massive right now. Companies are spending billions on data centers. Cloud providers are building huge AI infrastructure. But what happens if that spending slows down? Imagine a major customer suddenly says, we're going to delay this data center project by 2 quarters. For a company like SMCI, that can make quarterly numbers look very different. And this is why I don't like looking at one amazing quarter and assuming the next 4 quarters will look exactly the same. AI spending is real. I believe that. But spending cycles can still move up and down. The good news is that Supermicro has been expanding its customer base. Management said the company had 9 customers contributing more than $1 billion each in fiscal 2026 compared with 4 the year before. That's a positive sign, but investors still need to watch customer concentration and deployment timing. And now we're getting very close to the risk I think could matter the most. Because even if SMCI delivers huge revenue, even if AI demand stays strong, there's still one major problem investors need to think about, and that's expectations. That's where risk number 5 comes in. Now we get to the 5th risk, and this is the one I think deserves the most attention. Risk number 5, expectations. This might sound strange. SMCI has strong results. It has a huge backlog. It has a massive revenue forecast. So why would expectations be a risk? Because sometimes a company doesn't need to disappoint badly for the stock to fall. It only needs to disappoint relative to expectations. That's how the stock market works. If investors start pricing in perfect execution, then even a very good quarter might not be good enough. And we've already seen how sensitive SMCI can be. The stock has moved dramatically around major announcements and earnings. So at around the high $30 area, my question isn't simply, can SMCI reach 50? I think it absolutely can if the company executes. My base case personal target would be around $50 to $55 over the next 12 to 18 months, assuming AI demand remains strong and margins don't collapse. My bullish scenario, if that $65 to $72 billion fiscal 2027 revenue guidance starts turning into actual results, margins remain healthy, and the AI infrastructure cycle stays strong, I could see a move towards $60 to $70. But there's also a bear case. If margins weaken badly, customer deployments get delayed, competition becomes more aggressive, or AI infrastructure spending slows down, I wouldn't be surprised to see SMCI fall back toward the $30 area. And that's exactly why I wouldn't look at SMCI as a simple AI stock going up story. There is a real business here. There is real demand, but there is also real execution risk. And personally, I think the most important number isn't even the $60 billion backlog. It's what percentage of that demand turns into profitable revenue. That's the part I'm watching. So now I want to hear from you. Where do you think SMCI is going next? Can Supermicro hit $50? Can it reach 70? Or do you think the current AI excitement is already priced into the stock? Drop your target in the comments. And don't just say bullish or bearish. Give me your actual price target. For me, I'm watching the $50 level first. If SMCI gets there while maintaining strong margins and revenue growth, I think the bigger targets become much more interesting. But if margins start falling again, that's when I'd become much more cautious. If you enjoyed this analysis, hit the like button because it really helps the channel, and subscribe if you want more SMCI, Nvidia, AMD, AI stocks, and real-world stock breakdowns without all the hype. Because with AI stocks, the biggest opportunity can sometimes come with the biggest risk.